Welcome. My name is Sasha Moore, and we're here today with Chris Levy and Ben Lacey, both SMSF audit experts and partners at Aquila Super, to hold the first SMSF Tech Talk live webinar for 2026. We're holding this webinar to provide SMSF advisors, accountants, and auditors with real-time questions to common technical areas across a broad range of scope. So we've received several pre-registered questions, which we're going to start with. And in the meantime, please be sure to submit your questions either via the Q&A section or in the chat function, and we're going to get through as many as possible. So let's get cracking and let's get started. So Chris, Ben, welcome today.
Hi, Sasha.
All right. So we're going to go right off the bat with a question that's come through from a Krish. So Ben, I'm going to throw this to you, being a crypto specialist, to say, okay, cryptocurrency and wrap, what is the best audit approach when the crypto portfolio does not have a type 2 audit report?
Okay, right. So, in relation to, if I'll just define what a type 2 audit report is, that's a really important document that auditors look for any sort of portfolio, crypto or not. Okay, it basically is a style of assurance report that provides comfort to an auditor that the controls around how the reports have been prepared have been tested, and that the figures that are being reported are accurate. Okay, and when you have one of those reports, it basically means that you can reduce the amount of substantive testing you have. Now, when we're talking about crypto portfolios specifically, basically most of them don't have type 2 controls reports. So this sort of question sort of applies to a large proportion of crypto portfolio wraps in Australia at the moment. And if we're talking about substantive testing of cryptocurrency, you're really going to be focusing on getting access to the wallet addresses that the portfolio provider has to see if you can test on the blockchain to confirm the transactions and confirm the balances and the like. Now, that's sometimes going to be possible if they've got direct holdings or the provider is willing to provide that information to you. But there are sometimes big, large custodial holdings and the like, and they might not be willing to do that. Now, from a audit perspective, if you can't complete sufficient testing, in general, what you should be doing is informing the trustee that there is a limitation of scope that you have in relation to that portfolio asset. And if it's material, there might be times that you need to consider modifying the audit report just to formally advise the trustee of that.
Thank you. And Catherine's also had a crypto question that you may have covered in terms of what documents are required for crypto, cold wallet crypto.
Okay, for cold wallet crypto. So when we're talking about a cold wallet, we're sort of talking about a trustee managed device that holds the pass keys for the trustees to be able to transact in the cryptocurrency. Okay, so whenever a lot of trustees are doing this now because they feel this is probably more secure than holding it with some providers. So the standard questions are going to be, we're going to want to see the wallet addresses for the various cryptos that are held. And once we get the addresses, we run those through blockchain explorers, and then we can from that verify the balance of the cryptocurrency that are held, and also all the various transactions that are on the blockchain. Now, when it comes to a self-custodial holdings of cryptocurrency, there's some sort of finicky bits with crypto because you're not allowed to acquire crypto off yourself. You've got to be really careful about if it like where the crypto has come from or where it's going and the like. And because you can see every trade that ever existed on the blockchain, auditors basically need to go through a lot of that, work out the sources of any of those transfers. So if they've come from somewhere, did it come from an exchange? Was that exchange in the name of the super fund, or did it come from the members, or did it come from somewhere else? Is the pricing at a market value, etc. And that also goes for the balance at year end. It's like confirming that the pricing is like a spot price that is associated with the appropriate crypto. Now, on top of that, because you're holding it in a cold wallet, it's really difficult for an auditor to determine if it's legally the super funds. Obviously, if you hold shares, for example, with a registry, there's a legal title associated with it. But just due to the nature of cryptocurrency, the nature of the asset, there is no legal title associated with it. So, not only are you checking the provenance of how the crypto was acquired, like if it was acquired from an exchange, was it acquired in the fund's name at that time and then transferred to the cold wallet? You're also probably going to get the trustee to provide like a signed declaration or acknowledgement confirming that the wallet address or the addresses are all held for the super fund for the sole benefit of the super fund beneficiaries, and that they're not mixing it up or using it for personal reasons and the like. And lastly, in relation to the value of the cryptocurrency, the actual value of the crypto is really tied to the trustee's ability to transact in it. And I could provide you with a blockchain address you could run through an Explorer that says I have 100 Bitcoin, but if I can't buy and sell it, then I don't really have 100 Bitcoin. So there is also sometimes styles of testing for a trustee to be able to confirm that they can actually transact in the crypto. And one of late is sort of using messaging services that certain wallets and certain crypto providers allow, and which may allow a phrase or something to be put on the blockchain, and the auditor can see that, and which shows that, hey, they have the ability to transact in it. Yeah, I won't go too much deeper, but that kind of covers a lot of it.
Thank you so much, Ben. Chris, I'm going to throw this next question to you, who's come through from Brian. Is the DSFA limit of 1.6 million going to change anytime soon?
Yeah, look, this is super obscure. It's interesting, but it doesn't come up a lot. And for those who don't know, so this disregarded small fund asset limit, it's probably the worst worthy design description of something ever. But essentially it's got to do with the ability of a fund and members to segregate for tax purposes the assets where they have sizable balances. And it comes back from the original 1.6 million when they first brought in those caps. And essentially what the government's concern was is that if when back in 2017, when they sort of these funds sort of, they had like large balances, and they put in the transfer balance caps, and the pensions were reduced down to the 1.6, and they had those accumulation accounts. They were concerned that it's going to be shenanigans about asset allocations and people and members pushing what would you say, sort of low tax investments into the accumulation, have the high tax and the pension. So what they did is essentially they said, well, look, if your a member's balance exceeds the 1.6 million cap, you're not allowed to do segregation for tax purposes. You have to use a proportional basis. Now, obviously, that 1.6 million for transfer balance caps has increased in time. It's not $2 million and going up, but the 1.6 has stayed the same. And which is it's bizarre. I haven't heard anything about it. People don't really. I haven't heard it discussed in the last couple of years. So it is interesting. However, what I would say is part of the reason for that is because it's very rare. Like even before this measure came in, the segregation of assets was very unusual for self-managed super funds. There's a lot of complications using the segregation method where we're not all in pension mode. And so it was very unusual to start with. And I was actually involved when the legislation came in back, when they put these caps on pensions. I was involved in one, and typically the type of people, the type of members that would have some interest in segregating the assets, in pushing, basically splitting up their investments into high tax and low tax, for want of a better description. Those men, they've got lots of money, and it's actually in some ways administratively easier and sometimes more cost effective to just say, well, we're just going to have two funds. And that's actually ultimately what these people did. And so, yeah, look, this limit is it's bizarre that they haven't indexed it as well, but there's an easy workaround to it, and so, yeah, it's yeah, I haven't heard anything about it, but yeah, it's yeah, I don't expect to hear any change either. But yeah, not something we as auditors face pretty much ever. But yeah.
Okay, great. Thanks so much, Chris. Ben, I'm going to throw back to you. We've had a question come in from Sarah. Loans made to non-related parties, what elements must loan documents contain if drawn by non-lawyers other for ATO compliance?
Okay. Look, I generally have a pretty blanket statement for this for any form of loan that you're going to have in an SMSF is whether or not it's to a related party or an unrelated party, it's irrelevant. It really should just have standard commercial terms in that loan. Now, they're saying they want to use loan docs that have been drawn up by non-lawyers. I mean, that's a risky approach, okay? But I mean, it's feasible from an audit perspective. It can be done. I would say that my recommendation would be to review commercial loan documents to get an idea of what what should be in it. Okay. Now, especially if we're talking about unsecured loans, okay, which is probably what we're talking about if we're talking about non-lawyers doing a loan to an unrelated party. I think that what people get called out on a lot is the interest rate that they're using. There seems to be this view that if it's not with a related party, you just have this free reign of any interest rate you want. And also kind of the repayment terms. Like from an audit perspective, if we're seeing an unsecured loan in a fund and we're seeing it, I'm just going to throw out a number like 3% or 2% on that loan, and it's a sizable part of the fund. There are big questions about why the trustee would be making that decision. And although there's this view of, well, if it's not to a related party, like by definition, it's market, that's not necessarily true because we've had experience with the ATO where whether or not a loan is related or not, their view is you need to benchmark it against a commercial loan to prove to us that you're using an arm's length rate. Okay. And whether or not an auditor might decide to qualify or not, because the borrower might not be related, the trustee is putting themselves at risk because there are wider issues in the SIS Act for a trustee to be a prudent investor and act in the best interest of the members. And so if there is an unsecured loan, for example, and the rate is below what you could get with a term deposit, let's say, for example, it really raises questions if the trustee is meeting these obligations and satisfying the trustee covenants and governing rules. So if I sort of finalize on what I think, benchmark, whether or not it's related or unrelated, benchmark against commercial loans and benchmark against going out and getting a quote from a commercial lender for a loan with exactly the same terms. So whether it's secured or unsecured, if it's 3 or 4 or 5 years, that kind of thing. And that will, if you use that interest rate, it's super great. I guess the other thing to consider is sometimes we see loans where they might go, okay, there's no requirement to repay interest or capital until the end of the term. Now, I think if that's a 12-month loan, that might be okay. But I mean, I've seen 7 and 10-year loans where people are saying that, and you start to question, well, that really ties in again to what interest rate are you getting on this return, and just how good a decision is to tie up potentially, if it's material, significant amounts of funds with no return, but until the end of the project, there are other questions. Now, it's whether or not it's an audit breach might not be there, but again, you've got these kind of operating standards that the ATO have, these kind of levers that they can look at. So there's risk there. So I guess, yeah, benchmark and try and keep things as commercial as possible. And whether or not a lawyer's drawing it up or not, I think you can get pretty good loan agreements like online from providers, and that's probably a really safe bet to go on. Yeah.
Mm. Can I just add to that, Ben? Like I fully agree with what you said. We there was one that I was involved in, and the interest rate was 8%. So it wasn't like term deposit; it was a bit higher than that. ATO was concerned about that, and they were also concerned because yes, the interest was capitalised, and it was a 5-year loan, and you only pay at the end. So they had a real concern about that. So yeah, as far as documentation on the file, what I'd suggest is get comparable interest rate things. I think CanStar do that sort of stuff for unsecured loans. But also what they're asking for is documentation on the actual borrower. You can't actually driver's license for privacy reasons and stuff, but just something to say that you've got something on file where you can give to the auditor to back up who the borrower is. Because that's a concern. And then every year, the auditor will be looking at the recoverability. So if it's been lent to an entity, the financial statements of that entity. What do you reckon, Ben? Is that sort of stuff you're looking for?
Yeah, I would agree. I mean, just overall, loans in SMSFs, it's not a set and forget type of thing. There's quite a bit of stuff to consider. And so if a trustee is wanting to go down that path, they just need to know that from an audit perspective, it's very hard to audit unsecured loans for many years just based on a trustee ticking a declaration saying, oh, yeah, it all exists. Like you need to dig into it each year. And so it can be a little bit of a headache. Yeah.
Absolutely.
Thanks so much. So we've had a question come in from Juan about property valuations, questioning how often should the valuation be requested. Chris, what are your thoughts?
Look, this is like my pet question. This is and I'm glad it's here. Great question. And the reason why is because and I've been I apologize to everyone. Every time I have one of these webinars, I talk about valuations. It's still very much seems to be the big area where audits just grind to a halt. The valuations just not meeting the ATO expectations. So look, I'll look. I guess the first thing is I think accountants really need to get an appreciation of where the ATO is coming from, what their paradigm is, how they approach these, and well, for starters, they expect the trustees to reassess the value every year, and that's sort of implicit in the SIS Act. And the way they have interpreted that is, look, you need to have sort of recent, not necessarily valuations per se, but certainly comparable sales. You need to have data that's recent, and in the old days, you just be talk about this 3-year thing. That was never a thing. We all kind of thought it was a thing, but actually it never was. And then it sort of turned into 12 months. If you're doing say 30 June 25 or anything in that 12 months is okay. The ATO through discussion groups and other commentary and things and presenting at seminars, they seem to be shifting more to I would say more like a sort of a 6-month window. And so if you're doing the audit of say 30 June 25, evaluation done within sort of say from 1 January onwards would be fine. There's a little bit of grey. Some auditors and I've noticed some from the ATO seem to be kind of okay with 9 months. But if you're getting beyond that, the ATO's position is no. Look, we don't accept that. If you have a valuation, so that's one I was doing recently, where the valuation was actually done on 30 June 24, and trustees, in a way, it's sort of justifiably annoyed that can't be used just out of the box for 30 June 25 because of that 12 months. So I guess the answer is how often do valuations have to be done? In a perfect world, what you would do is a valuation, say for 25, you do a valuation now, and then that valuation figure could be used for 25 and can also be used for 26, and then for 27, you'd either do another valuation effectively in 2 years' time. So there'd be this 2 years rolling valuation, and that I think is probably the gold standard. I do know some people, and what they do, but they actually do it every 3 years. But then in the intermediate years, they use the valuation as a starting point. Granted, it's by that stage a year and a half old, But then they supplement it with comparable data and sort of property research on the market. For example, it might be sort of outer Sydney industrial warehouses. They'll provide commentary on that in terms of movements. So that can also be used. But yeah, it's either 2 years or 3 years. But you've got to be careful with the dates. And this is one of the key things we say to accountants. Look, if you're going to get a valuation, do not tell the valuer to value it as at 30 June. Do it now, and so as a consequence, they use comparable sales now, not sort of 6 months ago or 9 months ago. So, every 2 years should, is optimal.
Great, thank you. So, Chris, I'm going to stay with you.
Hmm.
We've had quite a few questions coming in about Division 296. So, I'm just, rather than going through the specifics of those, let's just throw that out as a category.
Okay. All right. So, look, this has obviously been bubbling along for years and years and years. For those that aren't aware, the government released legislation, I think it was like a week or so before Christmas, and gave a very quick sort of turnaround time or response time for feedback on that, a couple of weeks. So there's a whole bunch of super professionals beavering away over Christmas and New Year's. And so now it's sort of we have a reasonable idea about how it's going to work. Now, look, I will say there are still quite a few regulations to be sorted out. There's still some things that need to be nailed down, and that will come. But I think it's worthwhile, for most accountants, to sort of familiarise yourself with what's going to happen. Especially, obviously, those accountants that do have clients that are going to be not just in having balances or members having balances over 3 million, but members that are approaching that, and in the future will go over those limits. So look, I guess the first thing I'd say is this is one of those very rare occasions where it's better to be an auditor than an accountant. Because as auditors, we really don't have much to worry about. This is your jam, accountants. And now there is one big exception. We'll talk about that. But this is. When I was reading through the mechanics of it, it sounds messy. There's a lot of complications, but I suspect that the software, your accounting software, will do all the heavy lifting. If you're using proper superannuation software, if you're still using basic stuff, MYB, handy tax, you're in for a world of hurt. But I think for most accountants, they should be fine. So brief overview. Look, there's two thresholds. They've got one kicks in at $3 million, and it works on total superannuation balance. So it doesn't matter what's in one fund; they look at everything, and they're also including defined benefit funds as well. It's a sort of the old total super balance type calculations. So the first threshold is 3 million, and at that stage, the member will incur an extra 15% tax on their sort of taxable Div 296 earnings. The next threshold is 10 million. And if they go, the proportion that goes over that, well, that will attract another 10% tax on those earnings. So there's two thresholds there. And the general rule is they look at the total super balance at the start of the year and the end of the year, and whatever's higher, that's what they use. So it's a very simple calculation. For the very first year, which is the year starting in a couple of months, they will only be looking at the balance at 30 June 27. So there is some ability for people to, if they were concerned about this, to sort of jiggle around their superannuation amounts. We've seen instances of people that are quite in their sort of 70s and 80s, and are actually saying, well, look, I was planning to give to the kids anyway. So they start bringing all that forward. So there is room to strategize and maneuver before some of these high net worth superannuation members have to deal with this. Let's see what else. Now, what they do, and look, I will say before I go to this stage, they obviously adjust these balances as well. They remove contributions, they add back lump sums and pensions. So there is some sort of reworking, and essentially what they've done, it's clever in a way. What the methodology, it's just a pain in the neck for accountants, and so essentially what they're doing is they're saying, all right, once you're caught in this net, they're saying to the fund trustees, what proportion of the taxable income belongs to this member, and so now that's not it's you can't just take the figure from the tax return because there's add backs and things, or there's things have to change. And look, so like obviously contributions, you've got to add back exempt pension income, and so those things get added back, and that's fairly straightforward to work out. But then there's this complication with capital gains, there's a transitional measure, and I'll come to that because that's where I think where the big headache's going to be. And so, if you've got, like say 100,000 of taxable income and 50, the particular member has half of the fund, well, that 50,000 will be reported to the ATO. Now, their share, that 50,000 taxable income gets reported to the ATO, presumably on the tax return. Look, we understand that there seems to be a drive to get actuaries involved for that. Like these big funds may have to actually engage an actuary. I mean, it's similar to the actuarial certificates where you just punch things in and they push back an actuarial certificate. So it's no humans involved. So there will potentially be added cost. At the end of the day, there's going to be this one figure, this taxable income attributed to these high net worth individuals, which goes off to the ATO. And then they do the calculations, and essentially what they'll do is they'll say, well, okay, you're rich super member, you've earned 100,000 in the fund, that's your share, and then they do this sort of a standard proportional thing and say, okay, well, this portion here relates to the first 3 million, this portion here relates to the next, everything above that gets the 15% extra tax. And then if you go over the 10 million, well, then you get an extra tax on an extra 10%. And they work it out. The ATO work it out. And don't forget, all super funds are reporting this. And so it goes to the ATO. They've got all of the Div 296 taxable income from all these different sources. They pull it together and they go back to the member and they say, bang, there's your 296 liability. You can go off to the fund to get it paid out, or they can pay personally or whatever. So it's a simple but messy way of doing it. And again, the software should do most of the heavy lifting. Now let's see what else. Okay, yes. So the complication, the thing where I was starting to go, oh, this is going to be a pain, is the first year. Now, if you think about it, that working out the taxable income attributable to each member from the tax return, I mean, that kind of sounds easy, but then you've got this nasty issue about the capital gains. Now, imagine there's a $400,000 capital gain that's come about from a sale of a property, but maybe only say 20,000 may have been come about through the period about from 1 July 2026. And so the ATO, they recognise this. And there was a big criticism previously about taxing unrealised gains. Well, now there's a concern about you're taxing the unrealised gain that's accumulated for all the years or decades that have led up to this point. And so you've got what they've done is they've said, oh, you can. I'm not going to say reset the cost base. You'll hear that term when professionals are talking about this looming Div 296 tax, but it's coming up with a new cost base. So you call it like the Div 296 cost base, and essentially there's this opportunity for 30 June 26 where trustees will be able to set a cost base, set the market value at 30 June 26, and so. Practically speaking, when a fund when a fund's trying to allocate that taxable income before they've added back contributions and exempt pension income and all that, and they've come up with a figure, but then they have to take off the net capital gains from from the tax return, and then they add back a revised capital gains. You have to redo the capital gain calculation specifically for Div 96 that removes the component. It basically gets rid of all of the previous capital gain, and it uses this new cost base to do it. Okay, so it's going to be messy, but again, once you get those figures into the software, and again, presumably the software will keep track of that that Div 296 values, it should be a very easy calculation. It'll just spit back and you'll spit out those figures. Um, so yeah, look, it's going to be messy, and so there is this opportunity, and it's an advantage. It's a good thing that they're doing. They're recognizing they don't want to tax people for capital gains built up over many years. So there is.
Thanks, Chris. I might just segue, if you don't mind,
Sure.
only because I'm aware of time being almost wrapped, and I just want to throw to a few more questions, unless you wanted to finish on that point.
I will say one thing. The final point I say is this transitional measure. You've got one chance to do it. You have to lodge it on a special ATO form, and it has to be lodged with the ATO before the 26th tax return date. So if you don't do it, you miss out. That was the thing. Although,
Fantastic. We've had a question that's come through from Anne-Marie, which is related to what you were just discussing, Chris. If one member in a pension has a lower amount than the other member who has the 3 million, is there a way to transfer the money to the member with a lower balance?
it's the normal way. Like, I mean, there's no special way. There's no special allowance for that. It's the old thing about, if you're trying to balance up people's, member accounts or whatever. It's the old thing about, well, you can pay a lump sum, and then that the other, the lower balance member can then, recontribute it, but maybe they can't. But it may be, so it's all the complications that we've had for many years about reweighting people's balances. The low balance member might be over, the $2 million cap. They can't put the money back in except for concessional contributions. So they're restricted in doing that. So yeah, every scenario is going to be different. Yeah.
Okay, thank you. And we've got time for one more question. Ben, I'm going to throw this to you. We've had a question come in from Abigail. This 6-month period before June 30, 2025, does this apply to commercial properties too? So this is relating to the valuation. Or can valuations be done within 18 months of the financial year to be acceptable if they're updating supporting comparable sales for the commercial properties?
Well, I mean, it's dependent on what the audit, your auditor's going to be comfortable with. But I mean, if it all stacks up, I think that that's reasonable. Again, it's not about, let's not get tied down on when the valuation, this idea of an annual valuation, or does it need to be done within 2 years or whatever. It's about, do you have sufficient evidence that the property is at a current market value at the balance date? Now, you could utilize a valuation report that is from 18 months ago, and which gives you, if it's a valuation report, it's going to be very detailed from a valuer, giving you a bunch of information. And then if there's a number of, good quality recent comparable sales, and it all aligns that, okay, that let's say the dollar per hectare or dollar per square meter of this commercial property is within this type of range, and it all seems to be reasonable. I mean, I think that is a sound, reasoned methodology. I'd say that once you start to get into 3 to 5 to 7 years, I don't think you could really use a valuation report and then kind of tie it in. It'd be best practice to, at least within 2 to 3 years, if it's a difficult property to value, kind of have that rolling valuation report going. But again, like, if all the evidence ties together and it all seems like a sound, reasoned methodology, I think it can certainly work for sure. Yeah. I think what Chris was saying in relation to this sort of 6-month idea is just this idea of, like, look, if you just want a simple solution, and in effect, if you get something done around December, January, you in effect can use that quite comfortably for 2 years, which means you can kind of have this rolling 2-year valuation approach. It's just like a strategy.
Yeah.
Okay, great. Well, thank you so much, Chris. Thank you so much, Ben. Thank you to everyone who's tuned in to listen today. Great news is we are going to be running these SMSF Tech Talks throughout the rest of 2026. So stay tuned for the next one. Really appreciate all of your insights, gentlemen, and for everyone who's listened today. See you next time.